Deep in the Brazilian Amazon, a mining operation extracts $8 billion worth of iron ore every single year. That's $22 million every day, extracted from red rock hidden beneath rainforest canopy. This is Carajás. And it's not just another mine. Vale's northern system moves 150 million tons of iron ore annually, making it one of the most profitable single commodity operations on Earth. The numbers sound impossible until you see what's actually happening here. We're talking about an industrial complex so massive it reshapes entire regions, generates revenue comparable to Fortune 500 tech companies, and controls a commodity that literally builds the modern world. But here's what makes Carajás different from every other iron ore mine you've heard about. The ore grade averages 66% iron content, the highest grade iron ore in active global trade. While competitors ship ore that barely hits 60% iron, Carajás consistently delivers premium product that steelmakers pay extra to secure. This quality advantage alone adds hundreds of millions to Vale's annual revenue. You're about to discover how a geological accident in the Amazon became Brazil's most valuable mineral asset, why this single mining complex influences global steel prices, and what happens when one company controls this much high-grade iron ore. And by the end, you'll understand why major economies watch this mine as closely as they watch central banks. Let's start with the basics, because Carajás isn't just one mine. It's an integrated mining system spanning the Carajás mountain range in Purest state, deep in Brazil's northern Amazon region. Vale operates multiple mines across this complex with names like N4, N5, and the massive S11D project that opened in 2016. Together, they form what mining analysts call the Northern System. The company moves this iron ore 892 kilometers south on the Estrada de Ferro Carajás Railway, one of the world's most productive freight railways. Those trains carry nothing but iron ore, running 24 hours a day to the Atlantic port of São Luís. Vale itself is worth tracking. The company trades on B3 in São Paulo and the New York Stock Exchange, with a market capitalization fluctuating around $50 to $70 billion depending on iron ore prices. But here's where the financial story gets interesting. Vale's entire northern system generated over $12 billion in revenue in recent years, when iron ore prices were strong, with Carajás contributing the majority. The profit margins on Carajás ore are extraordinary compared to industry averages. When iron ore trades above $80 per ton, Vale's cost advantage at Carajás means they're extracting significantly higher profit per ton than competitors in Australia or other Brazilian regions. Think about this differently for a second. Every ton of iron ore that leaves Carajás represents roughly $50 to $100 in revenue, depending on market prices and quality premiums. Multiply that by 150 million tons annually, you're looking at revenue that would rank Carajás as a standalone Fortune 500 company if it operated independently. The reserve situation makes this even more compelling. The Carajás complex holds proven and probable reserves measured in billions of tons of high-grade iron ore. Vale has publicly stated that at current production rates, Carajás has decades of mine life remaining. Some deposits in the complex are projected to produce well into the 2070s. Now, here's an open loop we'll come back to. Why does China buy so much Carajás iron ore that they're willing to pay premium prices? And what happens if that relationship changes? Keep that question in your mind. The geology here is what mining engineers dream about. These iron formations date back billions of years, created when oxygen first appeared in Earth's atmosphere and reacted with dissolved iron in ancient oceans. The result is banded iron formations, layers of magnetite and hematite, that run through these mountains at grades that are exceptionally high by modern mining standards. While many iron ore deposits globally average 55 to 60% iron, Carajás consistently delivers 65 to 67%. This matters more than you might think. Steelmakers pay premiums for high-grade ore because it requires less energy to process and produces less waste slag in blast furnaces. The premium for Carajás ore over benchmark Australian iron ore can range from $5 to $15 per ton depending on market conditions. On 150 million tons, That premium alone represents $750 million to over $2 billion in additional annual revenue. Every percentage point of iron content matters in steel production economics. A blast furnace processing 66% iron ore versus 60% ore produces more steel per ton of input material, consuming less coke and generating less waste. This efficiency advantage compounds across millions of tons. Chinese steel mills running on Carajás ore can produce more steel with lower energy costs and reduced carbon emissions per ton of output. In an industry where margins are often measured in single-digit percentages, these efficiency gains translate directly to profitability. It's why steelmakers compete to secure long-term supply contracts with Vale specifically for Carajás ore. But let's talk about scale, because the numbers become almost absurd when you break them down. The S11D mine, which reached full production capacity, processes iron ore using a dry processing method that eliminates the need for water-intensive beneficiation. This single mine at S11D has the capacity to produce 90 million tons annually. That's nearly 250,000 tons every single day coming from one operation. To put that in perspective, imagine filling an Olympic swimming pool with iron ore. S11D fills the equivalent of 40 Olympic swimming pools every 24 hours. The mines operate 24/7, 365 days a year. While you sleep tonight, Carajás will extract and process roughly 410,000 tons of iron ore. The physical infrastructure required to sustain this extraction rate is staggering. The railway that connects Carajás to the port runs dedicated trains of roughly 330 cars each, carrying up to 40,000 tons of iron ore per train. Multiple trains make this journey daily, and the railway itself represents a multi-billion-dollar infrastructure investment that took decades to build and continuously requires maintenance and expansion. Vale invested hundreds of millions just to increase the railway's capacity to handle growing production volumes. The Estrada de Ferro Carajás runs through challenging terrain, crossing rivers, cutting through forests, and climbing elevation changes that would make most freight railways uneconomical. But when you're moving $50 to $100 of value per ton, the economics work. At the port of São Luís, Vale operates Ponta da Madeira Maritime Terminal, capable of loading the largest iron ore carriers in the world. These Valemax ships, some of the largest bulk carriers ever built, can carry up to 400,000 tons of iron ore in a single voyage. Loading a Valemax takes roughly 2 days. The port facilities use massive conveyor systems and ship loaders that can transfer tens of thousands of tons per hour from shore to ship, ensuring vessels spend minimal time at berth to maximize port throughput. The ship loaders themselves are engineering marvels, with booms extending hundreds of meters over the water, and capacity to pour iron ore into ship holds at rates that would fill a large dump truck every few seconds. This loading efficiency is critical to Vale's cost structure. The entire system from pit to port is engineered for one purpose: moving massive volumes of high-grade iron ore to global markets at the lowest possible cost. And it works with brutal efficiency. Vale's operating costs at Carajás are among the lowest in the global iron ore industry. Estimates place cash costs below $25 to $30 per ton, giving Vale significant margin even when iron ore prices decline. This cost advantage comes from multiple factors: high ore grades requiring minimal processing, economies of scale across massive production volumes, dedicated railway infrastructure, eliminating third-party logistics costs, and efficient port operations reducing demurrage time. The combination creates a cost structure that few competitors can match globally. Mining equipment at Carajás includes some of the largest haul trucks in operation, electric shovels with bucket capacities measured in cubic meters, and drilling equipment that can penetrate hundreds of meters. This heavy equipment represents billions in capital investment, but enables efficient extraction at scale. The maintenance requirements for this equipment fleet are substantial. Vale operates dedicated maintenance facilities at Carajás, employing specialized technicians who keep the mining equipment operational around the clock. When iron ore prices were above $150 per ton during recent supply crunches, Carajás was generating profit margins that would make technology companies jealous. We're talking about gross margins potentially exceeding 70 to 80%. At these price levels, every ton of ore extracted generated $100 to $125 in gross margin. When you're producing 400,000 tons daily, that's $40 to $50 million in daily gross profit from operations. Even at more moderate prices, around $70 to $80 per ton, the margin remains substantial. Vale's low-cost structure means profitability is maintained across most reasonable iron ore price scenarios. This is why Carajás is Vale's cash generation engine, funding investments across their global portfolio. The operation throws off billions in free cash flow annually, providing capital for mine development elsewhere, debt reduction, and shareholder returns through dividends. But here's where we need to go back in time, because Carajás wasn't always this massive operation. The discovery story is part mining legend, part geological accident. In 1967, a Brazilian geologist named Breno Augusto dos Santos was conducting an aerial survey for manganese deposits. His helicopter needed to refuel, so they landed on a mountain in the Carajás range. While waiting, dos Santos noticed reddish rocks exposed on the surface. He took samples. Laboratory analysis revealed they contained 66% iron, an extraordinarily high grade that made the discovery immediately valuable. This wasn't just any deposit, it was a world-class iron ore resource hiding in the Amazon rainforest, far from any infrastructure, markets, or existing mining operations. The discovery came at a time when Brazil's military government was pushing development in the Amazon region. They saw Carajás as an opportunity to generate export revenue, create jobs, and assert Brazilian sovereignty over a region they considered underdeveloped. Vale, then called Companhia Vale do Rio Doce, began exploration. By the early 1970s, they understood the scope: multiple iron ore deposits across the Carajás range, each containing hundreds of millions or billions of tons of high-grade ore. Early estimates suggested the region contained at least 18 billion tons of iron ore, making it one of the largest iron ore provinces ever discovered. Modern estimates continue to support massive reserve figures that justify decades of continued extraction. The geological surveys conducted throughout the 1970s used both surface sampling and extensive drilling programs to understand the deposit characteristics. Each drill core provided data on ore grade, mineralogy, and deposit geometry that informed mine planning. Vale invested millions in exploration during this period, drilling thousands of meters to define ore bodies and calculate reserves according to international reporting standards. This upfront investment proved essential for securing financing for infrastructure development. But discovering a world-class deposit and actually mining it are completely different challenges. Carajás was in the middle of the Amazon, 600 kilometers from the nearest port, with no railway, no power infrastructure, and no workforce. Vale spent the 1970s and early 1980s building the foundation. They constructed the railway, built company towns for workers, established power supply systems, and negotiated with the Brazilian government on terms for development. The railway construction alone was an engineering challenge that stretched across most of a decade. Building through the Amazon required clearing forest, constructing bridges across major rivers, stabilizing terrain prone to erosion, and establishing maintenance facilities every few hundred kilometers. The Brazilian government provided political and financial support, viewing Carajás as strategically important for the national economy. Development financing came from Brazilian development banks, international lenders, and Vale's own capital. Company towns were built from nothing. Workers and their families needed housing, schools, healthcare, recreation, and all the infrastructure of urban life, created in locations that were previously remote forests. Parauapebas, which would become the main city serving Carajás, didn't exist in any meaningful form before mining development began. Vale essentially created an urban center to support their operations. The first iron ore production from Carajás began in 1985. Initial production was modest by today's standards, but it marked the beginning of what would become one of the world's most significant iron ore sources. Early years focused on proving the operation, refining logistics, training workforce, and establishing reliability in delivery to customers. Vale was asking buyers to commit to long-term contracts for ore from a new source, requiring massive capital investment. Through the 1990s and 2000s, Vale progressively expanded Carajás capacity. New mines were opened, the railway was upgraded, port facilities expanded, and production volumes climbed steadily. Each expansion required substantial capital investment. Opening a new mine means stripping overburden, establishing pit infrastructure, deploying mining equipment, and integrating the operation into existing logistics systems. The N4 and N5 mines came online during this period, each contributing tens of millions of tons of annual production capacity. Vale was systematically developing the deposits they'd identified during initial exploration decades earlier. Then came the China boom. As Chinese steel production exploded in the 2000s, demand for high-grade iron ore skyrocketed, and Carajás was perfectly positioned to supply it. Chinese steel production grew from roughly 150 million tons annually in the late 1990s to over 800 million tons by 2015. This demand growth required massive increases in imported iron ore. Brazil's share of Chinese iron ore imports expanded significantly. Carajás ore was exactly what Chinese blast furnaces needed: high-grade, consistent quality, and available in massive volumes. Vale made a massive strategic bet. They committed billions to the S11D project, what they called the world's largest iron ore project under development at the time, designed to add 90 million tons of annual capacity. The decision to develop S11D came with significant risk. Iron ore prices were high when the project was approved, but commodity markets are notoriously cyclical, and Vale would be spending billions over multiple years before production began. S11D represented a technological leap forward. Unlike traditional iron ore operations that use wet processing with extensive water usage, S11D uses dry processing, eliminating the need for tailings dams entirely. The dry processing technology uses air instead of water to separate iron ore from waste rock. This reduces water consumption, eliminates tailings dam risk, and actually proves more efficient for the high-grade ore at S11D. But it also required developing and implementing technology at a scale never attempted before in iron ore mining. Vale was essentially betting $14 billion that dry processing could work at 90 million tons annually. The project cost over $14 billion to develop, one of the largest mining capital investments in Brazil's history. Construction employed tens of thousands of workers and required moving massive amounts of earth just to access the ore body. Development involved extensive infrastructure construction, new processing plants, conveyor systems spanning kilometers, expanded railway capacity, additional locomotive purchases, port expansion to handle increased throughput, and power system upgrades. When S11D reached full production capacity in 2020, it fundamentally changed Carajás from a large iron ore complex to an absolute giant. Total production capacity across the northern system exceeded 150 million tons annually. The timing proved fortunate. Iron ore prices recovered from lows in the mid-2010s, and by 2019 through 2021, prices spiked due to supply disruptions globally and continued strong Chinese demand. During peak pricing periods with iron ore above $120 per ton, the incremental revenue from S11D reached $10 billion annually. Vale's decision to invest during lower price periods proved strategically sound. Here's what that means financially. An iron ore price is around $100 per ton, which the market has seen in recent years. The annual revenue from Carajás exceeds $15 billion. Even at more conservative prices of $70 per ton, you're looking at $10 billion plus in annual revenue from this single mining complex. This is why Carajás represents Vale's crown jewel asset. The profitability varies significantly with iron ore prices. But at most price levels above $60 per ton, Carajás generates substantial cash flow. When prices spike above $100, the operation becomes extraordinarily profitable. Vale's Northern System EBITDA margin has reportedly exceeded 50 to 60% during strong price environments. Few businesses in any industry achieve margins in that range on revenues measured in billions. Now, let's talk about what this operation means for Brazil's economy, because the numbers extend far beyond Vale's balance sheet. Carajás directly employs thousands of workers in mining operations alone. When you include the railway, port operations, supplier companies, and contractor workforce, the employment impact reaches tens of thousands of direct jobs. Indirect employment through suppliers and service providers multiplies this further. Mining jobs in Brazil typically pay well above average wages, particularly in regions where alternative employment options are limited. Carajás workers earn salaries that place them solidly in Brazil's middle class. These wages circulate through the local economy, supporting retail businesses, restaurants, services, and construction. The multiplier effect means each mining job indirectly supports several additional jobs in the regional economy. For Purest state, where the mines are located, Carajás is an economic anchor. The operation generates significant tax revenue for state and federal governments through mining royalties, export taxes, and corporate income taxes. Brazilian government mining royalties on iron ore are charged as a percentage of revenue. The specific rate has varied over time based on regulation changes, but typically ranges in the low single digits as a percentage of revenue. On $10 to $15 billion in annual revenue, royalty payments alone reach hundreds of millions annually. These funds flow to federal, state, and municipal governments based on Brazil's revenue distribution formulas. Municipalities where mining occurs receive a direct share of royalties, creating concentrated fiscal benefits for local governments. This funding supports public services, infrastructure investment, and local development projects. But the economic impact goes deeper. Vale's operations in the Carajás region created entire cities that didn't exist before mining began. Parauapebas, the municipality where much of Carajás is located, has grown from a small settlement to a city of over 200,000 people. This urban growth happened in decades, not centuries. The population influx came from across Brazil, with workers and their families seeking employment opportunities in mining and supporting industries. The company built infrastructure that benefits the entire region: roads, power systems, hospitals, schools. The economic multiplier effect from this single mining operation has transformed the regional economy of southeastern Para. Before Carajás, southeastern Para was characterized by subsistence agriculture, limited infrastructure, and minimal connection to Brazil's industrialized south. Mining development fundamentally changed the region's economic trajectory. Local GDP per capita in Parauapebas and surrounding municipalities now exceeds national averages, driven primarily by mining-related economic activity. This represents a dramatic improvement in living standards compared to pre-mining conditions. At the national level, iron ore exports from Carajás represent a significant portion of Brazil's total export revenue. Brazil is the world's second-largest iron ore exporter after Australia, and Carajás accounts for a major share of that volume. Brazil typically exports 300 to 350 million tons of iron ore annually across all operations. Carajás' 150 million tons represents roughly 40 to 50% of national iron ore exports. When global iron ore prices rise, Brazil's trade balance improves substantially, strengthening the currency and providing more government revenue. When prices fall, the opposite occurs, demonstrating how closely Brazil's economic health is tied to operations like Carajás. During periods when iron ore trades above $100 per ton, Brazilian iron ore exports can contribute over $30 billion to national export revenue. This is comparable to or exceeding exports of soybeans, another major Brazilian commodity. The currency impact is measurable. When iron ore prices spiked in 2020 and 2021, the Brazilian real strengthened against the dollar, partly driven by improved trade balance expectations from mining exports. Here's a social math comparison to make this concrete. The annual revenue from Carajás exceeds the entire GDP of over 40 individual countries worldwide, more than nations like Chad, Nicaragua, or Benin produce in a year. To put it another way, the value of iron ore flowing out of Carajás annually is comparable to the total economic output of entire nations. One mining complex generates economic value equivalent to a small country's complete economic activity. And remember that question from earlier about China? Now we get to the geopolitical dimension, because this is where the story becomes about more than just mining. China consumes roughly 70% of globally traded iron ore. They import over 1 billion tons annually to feed steel mills that produce half the world's steel. This massive demand stems from China's role as the world's manufacturing hub and from decades of infrastructure development that consumed extraordinary amounts of steel for buildings, railways, highways, and urban construction. Carajás iron ore is particularly valuable to Chinese steelmakers because the high grade means lower energy consumption and less pollution in their blast furnaces. As China tightens environmental regulations, demand for premium ore increases. Chinese steel mills face increasing pressure to reduce carbon emissions and air pollution. Environmental regulations have forced closure of older, less efficient capacity, and surviving mills must meet stricter emissions standards. High-grade ore helps mills meet these standards more easily. Producing steel from 66% iron ore instead of 60% reduces coal consumption per ton of steel output, directly lowering carbon emissions. Here's the strategic tension. China's heavy dependence on imported iron ore, primarily from Brazil and Australia, creates supply chain vulnerability, and Beijing knows it. China produces some iron ore domestically, but domestic production covers only about 20% of their steel industry's needs. The remaining 80% must be imported, making China deeply dependent on foreign suppliers. Any disruption to Brazilian exports, whether from political instability, infrastructure failures, or mining accidents, directly impacts Chinese steel production. This gives Brazil leverage, but also makes Carajás a strategic asset that extends beyond commercial considerations. Vale has cultivated deep relationships with Chinese steel mills, including long-term supply contracts that provide revenue stability. Some Chinese companies have even invested directly in Vale through equity stakes or joint ventures. These relationships are mutually beneficial. Chinese mills secure reliable supply of premium ore, Vale secures committed buyers for their production, and both sides gain from relationship stability that reduces transaction costs and price volatility. The geopolitical calculus extends to competition with Australia. Australia's Pilbara region and Brazil's Carajás are the two dominant sources of high-grade seaborne iron ore, making them direct competitors for Chinese business. Australia supplies roughly 50 to 60% of China's imported iron ore, making them the dominant supplier. Vale's Brazilian operations, led by Carajás, supply roughly 20 to 25%. When political tensions between Australia and China escalated in recent years, Chinese buyers increased purchases from Brazilian suppliers like Vale. This demonstrated how geopolitical relationships can shift commodity trade flows worth billions of dollars. Though official government policy may not explicitly direct buyers away from Australian ore, Chinese steel mills understood the political environment and diversified their supply sources accordingly. Vale benefited from this dynamic. For Brazil, Carajás represents economic power. The ability to supply a critical input to the world's largest steel producer provides diplomatic influence and trade leverage that extends into other areas of Brazilian-Chinese relations. Brazil and China have developed a broad economic relationship extending well beyond iron ore, soybeans, oil, infrastructure investment, financial cooperation, and technology transfer. Iron ore is one element in this larger relationship, but an important one. Chinese investment in Brazilian infrastructure, energy projects, and even technology sectors is partly motivated by maintaining strong economic ties with a key raw material supplier. Brazil leverages this dynamic in diplomatic negotiations. The iron ore market itself operates on global dynamics that Carajás helps shape. When Vale reports production disruptions at Carajás, whether from weather, equipment failures, or other issues, global iron ore prices often react within hours. This is market power. A single mining complex influences the price of a commodity that trades in volumes exceeding 1.5 billion tons annually worldwide. Iron ore pricing primarily references benchmark contracts for Australian fines, with 62% iron content. Prices are quoted in US dollars per metric ton and trade on exchanges in Singapore, China, and elsewhere. Vale's Carajás ore commands a premium over this benchmark due to its 66% iron content. The premium fluctuates based on market conditions, but typically ranges from $5 to $15 per ton. During periods of tight supply, when buyers compete for available ore, premiums for high-grade material expand. During oversupply, premiums compress as buyers have more leverage to negotiate. Vale's ability to influence the market comes from their production scale. Announcing capacity expansions that will add tens of millions of tons to global supply can put downward pressure on prices, while production disruptions have the opposite effect. Let's be honest about the challenges, because operating a massive mine in the Amazon comes with significant controversies and real problems that have cost Vale billions. Environmental concerns are constant. Mining in the Amazon rainforest region raises questions about deforestation, water pollution, and biodiversity loss, and critics argue the environmental cost of Carajás outweighs economic benefits. While Carajás operations don't occur in primary rainforest, the region is environmentally sensitive, and mining activity affects local ecosystems. Concerns include air quality from dust, water quality in nearby rivers, and habitat fragmentation from infrastructure. Vale has faced lawsuits and regulatory challenges from Brazilian environmental agencies, indigenous groups, and international NGOs. These legal battles create uncertainty and sometimes result in production restrictions or additional compliance costs. Brazilian environmental licensing is complex and requires multiple levels of approval from federal, state, and municipal authorities. Expansion projects can take years to receive necessary permits, delaying investments and limiting growth. The tailings dam disasters at other Vale operations, particularly the Brumadinho disaster in 2019 that killed 270 people, fundamentally changed how the company and regulators think about mining risk. Although Brumadinho wasn't at Carajás, it impacted Vale's entire operation and reputation. Vale faced criminal charges, billions in fines and compensation payments, and a fundamental loss of social license to operate using traditional tailings dam methods. The company's market capitalization dropped significantly following the disaster. Vale was forced to decommission tailings dams across all operations, including some at Carajás, which reduced production capacity temporarily and required massive capital investment in alternative waste management systems. Decommissioning tailings dams at Carajás meant finding alternative methods for managing waste rock and processing residues. This required process changes, additional infrastructure investment, and acceptance of potentially higher operating costs. The S11D project's dry processing technology was partly a response to these tailings risks, eliminating water-based processing entirely. But implementing this technology was more expensive and complex than traditional methods. S11D's dry processing shows that alternatives exist, but they require significant upfront capital investment and ongoing operational adjustments. Not all ore bodies are suitable for dry processing, limiting how widely the technology can be deployed. Labor relations have also created challenges. Mining workers in Brazil are heavily unionized, and strikes have periodically disrupted Carajás production, costing Vale millions in lost revenue per day. Brazilian labor law provides strong protections for workers and unions, and mining unions historically have significant bargaining power. Wage negotiations, working condition disputes, and benefit disagreements can escalate to work stoppages. A single day of production disruption at Carajás means roughly 400,000 tons of iron ore not produced, translating to $40 to $80 million in lost revenue depending on current prices. Extended strikes have material financial impact. Infrastructure constraints remain an ongoing issue. The railway operates near maximum capacity, limiting how much additional production Vale can ship, even if they expand mining capacity further. The Estrada de Ferro Carajás was designed and built for lower capacity than current demand requires. Increasing throughput means adding track sections for passing, upgrading signals and control systems, purchasing additional locomotives and cars, and optimizing scheduling. Vale has invested hundreds of millions in railway upgrades and port expansions, but each increment of capacity requires years of construction and billion-dollar budgets. Growth is constrained by physical bottlenecks as much as geological limits. Port capacity at São Luís also faces constraints. Loading berths, stockpile areas, and conveyor systems all have maximum throughput rates. Expanding requires constructing new berths and infrastructure, facing regulatory approval processes and environmental concerns. Indigenous land rights continue to be a sensitive issue. Some Carajás deposits are located near indigenous territories, and expansion plans have faced opposition and legal challenges from indigenous communities who argue their rights are being violated. Brazil's constitution recognizes indigenous land rights, and development projects affecting indigenous territories require consultation and, in some cases, approval from affected communities. This creates potential veto power over Vale's expansion plans. Several indigenous groups have filed legal challenges against Vale and Brazilian government agencies, arguing that mining development threatens their territories, livelihoods, and cultural practices. These cases remain in litigation. These aren't abstract concerns, they're real constraints that impact production volumes, expansion timelines, and ultimately Vale's profitability from the Carajás complex. The regulatory environment in Brazil adds another layer of complexity. Mining regulations, environmental licensing, and taxation policies can change with political shifts, creating uncertainty for long-term planning. Brazil's political system features robust competition between multiple parties, and changes in administration at federal or state levels can bring significant policy shifts. Mining companies must navigate this uncertainty when making investment decisions spanning decades. Vale operates in a country where political instability and policy changes can dramatically impact mining economics overnight. This sovereign risk is priced into Vale's stock valuation and affects how investors view the company. International investors analyzing Vale factor in Brazil's political risk, currency volatility, regulatory uncertainty, and potential for policy changes affecting taxation or operational requirements. These risks demand higher returns to justify investment. Climate change itself poses physical risks. More intense rainfall events in the Amazon can flood operations, disrupt logistics, and delay production. Vale must continuously invest in infrastructure resilience against more extreme weather. Heavy rainfall can temporarily halt mining operations for safety reasons, flood processing plants or railways, and delay shipments at port facilities. Each disruption has financial cost in lost production and delayed revenue. So what happens next? The future outlook for Carajás involves several competing forces that will shape production and profitability over the next decade. On the supply side, Vale has announced plans for capacity expansions and productivity improvements that could push Northern System production even higher. The company targets efficiency gains through automation, equipment upgrades, and process optimization. Automation in mining involves autonomous haul trucks, remotely operated equipment, automated processing controls, and real-time data analytics for production optimization. Vale has been gradually implementing these technologies across their operations. The goal is reducing operating costs per ton while maintaining or increasing production volumes. Automation can reduce labor costs, improve equipment utilization rates, and enable mining in more challenging conditions. New deposits within the Carajás range remain undeveloped, representing potential future production growth if market conditions justify the capital investment. Vale has identified additional billions of tons of iron ore resources that could be converted to reserves. Converting resources to reserves requires detailed engineering studies, economic analysis showing extraction is profitable, and successful environmental permitting. Not all identified resources will necessarily become producing mines. That expansion faces constraints. Environmental licensing for new mines takes years and faces intense scrutiny. Infrastructure capacity limits how much ore can be transported and shipped, requiring continuous investment in railways and ports. Vale must balance growth ambitions against capital allocation priorities, environmental constraints, and market conditions. Overinvesting in capacity expansion during low price periods can destroy shareholder value if demand doesn't materialize. On the demand side, the outlook is complicated. China's steel production has likely peaked as the economy shifts from infrastructure-heavy growth to consumption and services, potentially reducing iron ore demand growth over time. Chinese steel production reached over 1 billion tons annually, a level many analysts believe represents peak demand. As China's infrastructure build-out completes and economic growth slows, steel intensity per unit of GDP is expected to decline. This means Chinese steel production may plateau or even decline gradually over the next decade. Since China consumes 70% of seaborne iron ore, this has enormous implications for Vale and Carajás. However, global steel demand continues growing in India, Southeast Asia, and Africa as these economies industrialize. The question is whether demand growth in these regions can offset potential decline in Chinese consumption. India's steel production has been growing steadily and is expected to continue rising as the country invests in infrastructure, urbanization, and manufacturing development. India could eventually become the second-largest steel producer after China. Southeast Asian nations like Vietnam, Indonesia, and others are also increasing steel production as they develop. These markets represent growth opportunities for iron ore suppliers, though volumes will take time to match China's scale. African nations remain early in industrialization and steel industry development. Long-term potential exists, but near-term impact on global iron ore demand is limited due to infrastructure and capital constraints. The energy transition adds another dimension. Steel production is carbon-intensive, and pressure to decarbonize could reshape the industry fundamentally. New technologies like hydrogen-based steel production could change iron ore demand patterns. Traditional steel production in blast furnaces generates roughly 2 tons of carbon dioxide per ton of steel produced. This makes the steel industry one of the world's largest industrial sources of greenhouse gas emissions. Reducing steel industry emissions requires either capturing carbon from blast furnaces, replacing coal with alternative energy sources, or fundamentally changing how steel is produced using hydrogen direct reduction or electric arc furnaces. High-grade ore like that from Carajás may become even more valuable if carbon costs rise, because premium ore enables more efficient, lower-emission steel production. This could strengthen Vale's competitive position. If carbon pricing or emissions regulations increase significantly, steelmakers will prioritize efficiency gains to reduce compliance costs. High-grade ore provides efficiency advantages that translate directly to lower emissions per ton of steel. Vale itself is investing in sustainability initiatives, including reducing carbon emissions from operations, expanding renewable energy use, and developing lower carbon products. These investments will cost billions, but are viewed as necessary for long-term competitiveness. The company has set targets for reducing Scope 1 and Scope 2 emissions from their operations, requiring investment in renewable energy, energy efficiency improvements, and process optimization. Vale is also developing lower carbon iron ore products that enable steelmakers to reduce their emissions. These products command potential premium pricing, creating new revenue opportunities alongside environmental benefits. The company has also committed to zero deforestation targets and stricter environmental standards across all operations. Implementation will be expensive, but potentially reduces regulatory risk and improves social license to operate. Meeting zero deforestation commitments requires careful management of all land disturbance, restoration of previously impacted areas, and potentially offsetting any unavoidable impacts through conservation elsewhere. Competition from Australia remains intense. Australian iron ore miners like Rio Tinto and BHP continue investing in production capacity and efficiency improvements, maintaining pricing pressure on Vale. Australia's Pilbara operations benefit from proximity to Asian markets, reducing shipping times and costs compared to Brazilian ore. This geographic advantage provides structural cost benefits that Vale cannot fully overcome. However, Australian ore grades are generally lower than Carajás, typically ranging from 58 to 62% iron content. This quality difference partially offsets their logistics advantage. Geopolitical risks cut both ways. While Carajás benefits from China's desire to diversify away from Australia, any Brazilian political instability or trade conflict with China could rapidly shift flows and prices. Brazil's political system has experienced significant volatility in recent years, with corruption scandals, impeachment proceedings, and sharp ideological swings between administrations. This creates uncertainty for multinational companies and trading partners. The iron ore market itself may become more volatile. As mine supply becomes concentrated in fewer sources, price swings could become more extreme, creating both opportunities and risks for Vale's profitability. Market concentration means fewer suppliers have market power, but it also means supply disruptions at major operations have outsized price impact. This creates volatility that challenges planning for both producers and consumers. Here's what analysts generally agree on. Carajás will remain one of the world's most important iron ore sources for decades to come. The geology is simply too good, the infrastructure is already built, and the cost position is too competitive for this to change quickly. No new greenfield iron ore project anywhere in the world can match Carajás' combination of high-grade ore, established infrastructure, and low operating costs. This provides durable competitive advantage. But Vale's ability to grow production, maintain profitability, and justify continued investment will depend on navigating environmental challenges, infrastructure constraints, market volatility, and geopolitical shifts successfully. The company must balance multiple stakeholder demands. Shareholders want returns, workers want fair wages and safe conditions, communities want environmental protection and economic benefits, governments want tax revenue and development, and customers want reliable supply at competitive prices. Now, here's the revelation that ties everything together, the piece that makes Carajás truly unique in the global mining landscape. This isn't just about iron ore, it's about the concentration of value. Carajás generates more annual revenue per square kilometer than almost any other mining operation on Earth. The density of high-grade ore, combined with low-cost extraction and premium pricing, creates extraordinary value per unit of land disturbed. Think about this. Some gold mines cover larger areas, use more energy, employ more people, and generate less annual revenue than this single iron ore complex. That's the power of grade and scale combined. Gold mines often have operational costs exceeding $1,000 per ounce and may produce only a few tons of gold annually. Even at high gold prices, revenue per square kilometer of mining activity can be lower than Carajás, despite gold's much higher unit value. The in-ground value of remaining reserves at Carajás, calculated at current iron ore prices, likely exceeds $100 billion. This is the remaining wealth locked in these mountains, waiting to be extracted over the coming decades. Vale essentially controls an asset that generates Fortune 500 level revenue, requires relatively limited operational complexity compared to manufacturing or technology, and has decades of runway remaining before depletion becomes a concern. This is why Carajás matters beyond Brazil, beyond iron ore markets, beyond even Vale's corporate success. It represents how geological accidents, industrial infrastructure, and global demand create concentrated value that shapes trade flows, currency valuations, and economic development. The people who control high-grade natural resources, like Carajás, hold tangible assets that can't be replicated, disrupted by technology, or easily substituted. You can't software engineer your way to high-grade iron ore. In a world increasingly dominated by intangible assets like intellectual property, brand value, and network effects, natural resources remain stubbornly physical. You must have access to the ore body to extract value from it. And here's the final piece that few people realize. When you drive across a bridge, enter a skyscraper, or ride in a car, there's a reasonable chance some of the steel in that structure started as iron ore from Carajás. This remote mining complex in the Brazilian Amazon literally provides the raw material foundation for modern infrastructure worldwide. $8 billion annually, extracted from red rock, transformed into the steel that builds civilization. Steel from Carajás iron ore is in buildings across China, infrastructure projects throughout Asia, automotive manufacturing in multiple countries, and construction projects worldwide. The material impact is impossible to fully trace, but undeniably significant. The financial magnitude is obvious when you see it all at once. 150 million tons of premium iron ore, shipped 892 kilometers by dedicated railway, loaded onto the world's largest bulk carriers, delivered to steel mills in China and beyond. Every day, without interruption, this industrial system operates at a scale that would have been unimaginable when Dos Santos first picked up those rock samples in 1967. What started as a geological curiosity became Brazil's mineral crown jewel. The workers who operate the shovels, drive the trains, manage the port operations, they're participants in a supply chain that feeds the global steel industry. Their daily work in Purest influences construction costs in Shanghai, infrastructure projects in India, and manufacturing in Europe. Vale's executives in Rio de Janeiro watch iron ore prices in Singapore futures markets, negotiate supply contracts with Chinese steel mills, and make billion-dollar investment decisions about Carajás expansions. These decisions ripple through Brazil's economy and impact commodity markets worldwide. The Brazilian government collects royalties and taxes that fund schools, hospitals, and infrastructure across the country. Communities in Para that didn't exist 40 years ago now have economies entirely structured around this mining operation. And through all of this, the fundamental geological reality remains unchanged. Beneath those mountains in Carajás lie billions of tons of 66% iron ore, the highest grade seaborne iron ore in global trade. This grade advantage, combined with efficient operations and established infrastructure, creates sustainable competitive advantage that will last as long as the reserves hold out. And at current extraction rates, that means decades of continued production ahead. The market recognizes this value. When analysts value Vale as a company, they specifically highlight Carajás as a premium asset that commands higher valuation multiples than average iron ore operations, and rightfully so. Vale's market capitalization reflects the value of their entire portfolio, but financial analysts often break down contribution by operation. Carajás consistently ranks as the highest value asset in the portfolio. But let's zoom out one more time to see the bigger picture, because Carajás represents something larger than one company or one commodity. It's a case study in how natural resource wealth creates economic power. Countries and companies that control world-class mineral deposits gain negotiating leverage in global markets. They influence prices through production decisions, shape trade relationships through supply agreements, and extract economic rents through their market position. Brazil leverages Carajás to strengthen relationships with China, attract foreign investment, and generate export revenue that stabilizes their currency. This is resource diplomacy at scale, where geology becomes geopolitics. Vale leverages Carajás to maintain its position as one of the world's largest mining companies, generate shareholder returns, and fund diversification into other commodities and regions. The cash flow from Carajás underwrites corporate strategy. Chinese steel mills leverage their purchasing power to negotiate favorable contract terms, secure long-term supply, and ensure they have access to the premium ore needed for efficient, lower-emission steel production as environmental regulations tighten. Everyone in this value chain understands the strategic importance of Carajás. It's not just another iron ore mine. It's critical infrastructure for the global steel industry, packaged inside one Brazilian mining complex. The railway that connects mine to port, those trains running 24/7 carrying nothing but iron ore, that's not just logistics, it's a physical manifestation of how essential this operation has become to global commodity flows. When those Valemax ships leave port loaded with 400,000 tons of Carajás ore headed to China, they're carrying roughly $40 million worth of raw material in a single voyage. Multiple ships make this journey weekly. The financial flows match the physical flows in scale. Vale receives payment. The Brazilian government collects taxes and royalties. Workers receive wages. Suppliers get paid for services and equipment. And local communities benefit from economic spillover. Money generated from iron ore in Purest flows through financial systems, supporting economic activity far beyond the mining sector. This is how resource extraction creates multiplier effects throughout an economy. And the cycle continues. Vale reinvests profits into maintenance, expansion, and efficiency improvements at Carajás, ensuring the operation remains competitive and continues generating returns for decades to come. The company has already invested over $20 billion in developing and expanding Carajás over the past several decades. Every new mine, railway upgrade, and port expansion represents capital deployed to maintain production capacity and market position. These investments are massive, but they're justified by the reserve base and the long-term demand outlook for iron ore. As long as the world needs steel, Carajás will have buyers willing to pay for its premium ore. Capital allocation decisions at Vale weigh competing investment opportunities across their global portfolio. Carajás consistently ranks among the highest return projects, justifying continued investment even in uncertain market conditions. Now, before we wrap up, let's address one more question you might be wondering. Could another region replicate what Carajás has achieved? The honest answer is extremely difficult, bordering on impossible. You need several factors aligned simultaneously. First, you need a world-class geological deposit with high-grade ore measured in billions of tons. These deposits are exceptionally rare and mostly already discovered. Modern geological surveys have mapped most of Earth's surface with sufficient detail that major iron ore provinces are generally known. Undiscovered deposits of Carajás's scale and grade are increasingly unlikely. Second, you need to be able to build the infrastructure to extract and transport that ore economically. In Carajás's case, this meant constructing an 892-kilometer railway through the Amazon, requiring decades and billions in capital. Building equivalent infrastructure today would cost substantially more than Vale paid in the 1970s and 80s. Environmental regulations are stricter, land acquisition more complex, and construction costs higher in real terms. Third, you need access to export markets willing to buy massive volumes. Without Chinese demand for imported iron ore, Carajás would be worth a fraction of its current value. The timing of Carajás development coinciding with China's industrialization was fortunate, but not guaranteed. Had Chinese demand growth occurred decades earlier or later, the economics of developing Carajás would have been different. Fourth, you need the political stability and regulatory environment that allows long-term mining operations to function. Many countries have iron ore deposits, but lack the governance and infrastructure for development at this scale. Countries with significant iron ore resources but limited development include parts of Africa, Central Asia, and elsewhere. Political risk, weak infrastructure, and capital constraints prevent development of potentially valuable deposits. Fifth, you need the technical and operational expertise to run large-scale mining efficiently. Vale has refined Carajás operations over 40 years, accumulating knowledge and capabilities that aren't easily transferred. Mining expertise develops through decades of operational experience, technology development, workforce training, and incremental improvements. This institutional knowledge provides competitive advantage that newcomers struggle to match. When all these factors align, you get operations like Carajás or the Pilbara in Australia. When even one is missing, deposits remain undeveloped or operations struggle to compete economically. This is why the existing major iron ore provinces maintain their dominance. The barriers to entry for new world-class sources are enormous, protecting incumbents like Vale from new competition. It's also why Vale's market position at Carajás is so durable. Unless there's a fundamental shift in technology, like completely replacing steel with alternative materials, Carajás will remain strategically important for the foreseeable future. So where does this leave us? You now understand what $8 billion in annual iron ore revenue actually means in practice. You've seen how one mining complex in the Amazon influences global steel prices, shapes Brazil's economy, and serves as a critical link in Chinese industrial supply chains. You've learned why 66% iron content creates pricing power that adds hundreds of millions in premium revenue. You understand how 40 years of infrastructure investment and operational refinement created competitive advantages that new competitors can't easily replicate. And you've seen how geological reality, industrial infrastructure, corporate strategy, and geopolitical relationships intersect at Carajás to create concentrated value that extends far beyond the mining operations themselves. This is mining finance at its most fascinating. Not abstract commodities and price charts, but real operations where geology meets engineering, meets global economics, measured in millions of tons and billions of dollars. Carajás isn't unique because it produces iron ore. Hundreds of mines produce iron ore. It's unique because it produces so much, at such high grade with such efficient infrastructure, serving markets willing to pay premium prices, all while generating revenue that rivals major corporations in entirely different industries. The combination of factors that make Carajás exceptional is difficult to replicate elsewhere. This creates enduring value that will persist for decades as long as global steel production continues. The next time you hear about iron ore prices or Brazilian commodity exports or Chinese steel production, think about those mountains in Purest state. Think about the railway trains carrying 330 cars of iron ore through the Amazon. Think about the economic impact concentrated in one geological formation, discovered by accident during a helicopter fuel stop in 1967. This is how natural resource wealth works at scale. And if this story of geological accidents, billion-dollar infrastructure, and global commodity flows captured your attention, you'll want to stick around because we're just getting started exploring the world's most financially significant mining operations. Next time, we're going to Australia's Pilbara region, where 3 mining companies control 70% of global seaborne iron ore supply and generate profits that dwarf most countries' GDP. The financial magnitude there will make Carajás look modest by comparison. If you found value in this deep dive, subscribe so you don't miss it. Comment below with what surprised you most about Carajás, or tell me which mine you want to see covered next. Because at the end of the day, understanding operations like Carajás isn't just about mining, it's about understanding how modern economies actually function, where wealth comes from, and why controlling natural resources still matters in the 21st century. And now you know.